che io lascio direttamente a Chris Townsend, che è il CEO per International General Insurance di AIG, con cui parleremo di prospettiva internazionale delle sfide del risk management.
Comunque congratulazioni per l'organizzazione, che è veramente formidabile.
Thank you and good morning. Now, I apologize in advance that your English is going to be much better than my Italian, so I'm afraid I will do this in English. So, first of all, it's wonderful to be back in Milan. It's a tremendous city, and I appreciate the opportunity to be able to make some remarks to you today. So, I think with this theme of monopoly, it's important to say up front that risk is not a game. And you've heard a lot yesterday, and I'm sure you'll hear a lot today about the insurance industry and risk. But what I want to do today is to talk to you about issues which will very much occupy the minds of your CEOs and boards, and I think are globally very important to us in terms of the challenges we face in a very uncertain global environment. And since the early days of insurance, and think that Italy, and particularly places like Genoa and Venice, had an important part to play in this, where we insured early endeavours and we protected people against storms, piracy, war and revolution, we helped to spread global trade. And given the uncertainty we face today, how we actually respond to some of these uncertainties will not only impact our industry for the future, but will potentially impact the broader global business community. So I think one of the key challenges we're facing at the moment is uncertainty stemming from multiple geopolitical situations which cumulatively can be really quite alarming. Citizens' social and electoral behaviour is becoming increasingly unpredictable, and few would have predicted the success of many populist parties around the world. You see it very much here in Italy, you see it around Europe, and you see it around much of the Western world right now. Much of this is fueling within-country inequality, a trend which is particularly pronounced in some of the more advanced economies. Clearly, there's a risk that the UK could leave the EU without a deal. I'm very wary about talking about Brexit because it's only true for today. Who knows in a few hours when Prime Minister May has her cabinet meeting what the outcome will be. But there is a potential that the UK could leave the EU without a deal, which I think impacts not only the UK, but obviously much broader the EU. Take that further and think about the upcoming EU elections in May of 2019, and I think the broader inability of the European member states to find an effective solution to deal with economic migrants weakens the overall European project and potentially paves the way for populist solutions. Populist trends driven much by disenchantment with business and global trade following the GFC have very much eroded support for globalization and led to growing protectionist policies, mostly in the West. And this fear of a global trade war is becoming increasingly real. Just take a look at what the US have done since the new administration have come into place. They've taken the US out of the TPP in terms of that big Asia-Pacific trade deal. They've challenged TTIP. They've renegotiated the agreement with Canada and Mexico. They've renegotiated the agreement with Korea. So you've got NAFTA 2.0, Chorus 2.0, and obviously a very challenging and deepening trade spat with China. In Europe, multilateral trade is no longer seen as the panacea, and we see strong resistance to CETA and to TTIP by societal and political movements in Europe. Trade policies now very much have to take into account societal, fiscal and environmental fairness, and look no further than what France has done recently in terms of stating that they're not going to sign up to any trade deal with partners who won't agree to the Paris Agreement on climate change. All of this bodes very poorly for trade And if you think about that in the context of Italy and its manufacturing base and its requirement on open borders and global trade, at worst or at least it's a very complex situation. More broadly, the US's role as a global security and peace stabilizing force is increasingly being challenged, and a number of institutions that we all grew up with and we all relied on in terms of Western democracy are really being challenged now. And of course, we're seeing the pendulum swinging much more towards Asian economies as global trade moves more towards that part of the world. So one big challenge for boards and CEOs is clearly the broader geopolitical and trade environment. The second, I think, is urbanisation. And the number of city dwellers is growing at the moment by 500,000 people a week. So by 2030, 60% of the world's population will live in an urban environment. And many of those urban environments are built in areas which are highly exposed to nat-cat situations. So this growth of urbanisation and the associated rise in the middle class and the overall levels of income puts tremendous pressure on a range of areas. It puts pressure on services, healthcare, food, water, energy, and of course safety. It also raises the question as to whether the existing infrastructure in some of these mega cities can prevail and what needs to be done to provide a suitable future. And also, the flip side of that, or the converse of that, is how to deal with the areas which are being depopulated. The opportunity, of course, is immense. The opportunity for our industry is immense in terms of infrastructure projects, but it's also immense in terms of whole new consumer groups and changing customer demand going forward, which will open itself up to a range of new product and service opportunities. Let's move to the demographic situation. By 2030, the world's population will be 8 billion people. And all regions around the world will see an aging demographic. You see it very much here in Europe, you see it in Latin America, and of course you see it in Asia. But in Asia, it's not just Japan, Korea, and Australia, the three countries people always cite, but it's very much China as well. So China is concerned about getting old before it gets rich, and the fast-aging society in China puts a ton of pressure on their economy just when they can't afford it. So this dependency gap in terms of the number of working people to support the elderly puts a lot of pressure on the existing workforce, requires more women in the workforce in a number of jurisdictions, not so much Europe, and obviously requires broader participation by the elderly workforce. High levels of personal debt and high levels of government debt, coupled with inadequate health, inadequate savings, are one reason I think to expect that social frustrations might lead to more broader political unrest. The good part about this, though, is that there are tremendous opportunities for well-placed private sector companies. Again, aging demographics brings in a whole new range of consumer opportunities. And also, as you think about economies who struggle with their debt burden, it's really difficult for them to provide for all of the health and retirement needs of their citizens, and a lot of that will be pushed onto the private sector. So great opportunity exists for well-placed private sector companies, and you see that here in Italy as well, particularly in the health, benefits and medical expenses area. So business leaders very much need to re-examine their strategies to make sure that they're resilient enough to keep up with some of this demographic change. And the last big risk topic I want to touch on is that, obviously, of technological change. And again, this is, to my mind, much more of an upside than a downside, but it does provide a ton of challenges. We're living very much in the middle of a revolution, a connected revolution, often called the fourth industrial revolution, which we all know will have a deep and profound impact, not just on us in the room here, but in every business and every government and every society worldwide. The Internet of Things brings obviously a much greater prevalence of smart objects, and leads to a higher connectivity between them. So we're seeing now the influence of smart cars, smart homes, and smart cities. And this all bodes, I believe, tremendously well for us, particularly in manufacturing businesses, because the connectivity of these objects allows much better safety, much better machinery, and much more predictable outcomes. But what it does for the insurance industry, it puts pressure to keep up with that in terms of the engineering around that, but it also forces insurers to have to innovate in terms of other products and other services to remain relevant to that part of industry. The downside of the connectivity is obviously that of cybersecurity. Tens of billions of connected devices means tens of billions of new access points for cyber criminals to enter a business enterprise. And this is an individual issue, a business issue, and a societal issue. Cyber risk is constantly in the top 5 of any CEO's risks globally, often number 1. And you see this survey after survey. Just in the car on the way over here this morning, I saw the World Economic Forum has just listed cybersecurity as the number 1 2018 risk. A couple of examples. Think about the NotPetya cyber attack. These are public numbers. FedEx cost them $400 million in data remediation. And it cost Merck $670 million in data remediation and in lost sales. I actually think the insurance industry has done a pretty good job to respond to this cybersecurity issue. But if you think about the overall size of the cybersecurity issue, it's hundreds and hundreds of billions of dollars of potential risk. And the total premium pool for cyber insurance right now is only $4 billion. So literally, as an industry, we're just scratching the surface. And I think we as an industry have to do much more to engage in the debate and not purely to sell insurance to risk managers to deal with a problem. Because many risk managers believe, quite rightly, look, they're better off spending money on fixing the problem rather than buying insurance to actually try to stem the problem going forward. So I encourage a combination of both of those from the insurance industry and risk managers in terms of engaging in a dialogue here. The key industries impacted by this are professional services, financial services, and retail, and they're very much at the top of the list when it comes to cyber incidents, but clearly it's a global issue impacting every industry, and I think it will only get worse in Europe with the influence of GDPR. We write the largest amount of cyber insurance in Europe, and we've seen an influx in claims, and that law was only brought into effect in May. The good news, though, is, look, the change in technology gives rise to a whole bunch of new business models, and you see time and time again in every industry how new capabilities are being brought to market, which literally decimate old established players. Automation has already had an impact, not just on the core business, but also in terms of disruptive labor policies around the world as well. McKinsey have predicted with the advent with AI that 30% of 60% of the jobs worldwide can be replaced with AI and technology right now. And think about what that does to employment levels. Think about what that will do to capping wage growth and further fueling income disparity. Because some people are going to do very, very well out of this, and some people will not have work. They'll be challenged from an economic perspective, and it will further increase that divide between the haves and the have-nots, and link that to some of the populist issues I mentioned before. It's a troubling situation. The good news is that in the insurance industry, there are a ton of new jobs arising out of this. Data scientist is one of the most sought-after roles in our industry right now. Drone pilots for claims. And The Economist has predicted that future jobs are going to include things like bot wranglers, virtual fashion designers, clearly something to do with Italy there, and hydroponic farmers, whatever they might be. So look, I just wanted to highlight some of those key risks which I think are topical for boards and for CEOs. So that's around geopolitical risks, it's around trade risks, It's around demographics, urbanisation, and obviously technological risks as well. So the key question is, what can businesses do to stay relevant in this challenging environment? And there's three things. One is to make sure we remain agile, and that means that businesses must embrace disruption and the disruption that business model changes bring. Secondly, to be resilient, to ensure that you have a resilient workforce. And third, I think as an insurance and risk industry, we need to do a much better job in defining our purpose. So let's tackle agility first of all. And rather than fear disruption, we very much need to embrace it, as the amended technology can have the potential to completely shift our industry. Now, the insurance industry has a bad rap when it comes to innovation, but our industry is very old. It's 300 to 400 years old. And think back to the early days of the trading areas of Venice and Genoa and the coffee shops in Lloyd's of London. Initially, capital was king. He who had capital won the day. Roll forward to more modern times, and you look at the Lloyd's building now, and for any of you who have been to the Lloyd's market or the London market recently, you'll see it's very symbolic. Look, there's two big brokers whose buildings literally tower over Lloyd's. So you've seen the value shift from capital through to distribution, and look at the market cap of the companies who own distribution. They've clearly been winning the day. Second innovation, I think we need to be quite proud of as an industry, is that of the influx of contingent capital, or the ILS market. Many thought it was a fad and it wouldn't survive. But if you think about what happened after the HIM losses of 2017, they happened in the fall of 17. By the end of the year, all of those funds had reloaded with capital. They were ready to deploy, and they were very active in the changed 1/1 renewal season. And that contingent capital market now is about $80 billion, and the overall global reinsurance market is about $400 billion. So contingent capital is now nearly 20% of the overall capital market for insurance. Now, I think that bodes really well for risk managers and for customers, because that capital fungibility allows insurers to take in risk and to farm it out to the most appropriate source, hopefully giving the best result through to the customer. I also think that innovation in the digital space, and you see this mostly in Asia, particularly in China, will lead to a whole new range of products and services. There's a company called Zhongang in China, and their main product is to do package return insurance for Alibaba. So think about a lady in Western China. She goes online, orders 4 dresses. She gets 4 dresses shipped to her. She tries them all on, picks one, and ships the other 3 back. Those other 3 are covered by an insurance policy, which costs about $1.10. And what that company has done very cleverly is to embed their product in a very modular fashion into an ecosystem, into a digital ecosystem which customers trust, they like, it's available when they want, and they want to use going forward. So I would predict that going forwards, particularly in the consumer insurance space, this modularization of insurance products down to like bite-sized chunks, and the embedding of those products into third-party ecosystems will very much be the future of our industry. The last item I want to touch on in agility is that of our value chain. We must embrace technology to reduce our very expensive and costly value chain. If you think about our industry, in many parts of the world, 40 cents of every dollar a customer pays us goes to our distribution and the way we run our business. So they're paying $1 for risk, and 40 cents goes somewhere else. So if we don't deal with that, I can assure you that someone else will. So as an industry, we've got to embrace technology to drive down the cost of our products and services. Traditionally, when you talk about agility, most people think of startups, and they think that big companies are too bureaucratic and they can't change. But that's, I assure you, is absolutely not the case. Bosch, from a An engineering perspective is a great example. They embraced the agile way of working. It was a process where they started with agile teams, reporting through to the supervisory and management board. They were only using it for new business and kept the functions in the old hierarchical structure. They then changed this, and the management board and all the functions adopted this agile way of working, and the whole organization is structured around these pods now, and it's had a tremendous outcome in terms of their business. And the best stat we've got on this is that they developed the chassis and safety systems for Tesla and did it in 1/3 of the time they did that previously. So clearly big companies can change in terms of the way they do things. AIG itself have been through our own transition. We're moving very much from what was a centralized organization to a decentralized organization, where we're pushing decision-making right to the edge of the company so our leaders in country can have the agility to respond to customer needs. At the same time, we're changing reinsurance to reduce the volatility of our business. We're reducing expenses to reduce the cost base of our business, and we're changing the culture of our organization. So you can do all of these things at once, but it takes strong leadership, and it also takes a very agile mindset to be able to do this. When we think of resilience, the second item, as insurers and risk managers, I think there are a few who can credibly talk about resilience more passionately because it's in our lifeblood. It's what we do all day, every day. We help communities to be resilient. We help people and businesses to get back on their feet when the worst has happened. And we help to rebuild and revive lots of people's opportunities. We also, I think, give them faith and give them a safety net. So if people didn't have that, they wouldn't invest, they wouldn't grow, and it would impact global trade. So we've got a really vital role to play in the community. However, what we've seen within AIG, given some of the challenges we've been through, it's vitally important to have a resilient workforce. And that resilience comes down to culture, and it comes down to the individuals having this concept of curiosity as to how to improve their business going forwards. And I firmly believe, and I've seen in our own organization, that unless you have a diverse workforce, you have one which is empowered, and you have one where you've actually spent time thinking about your employees' well-being, you can't have the backbone of resilience which you need for your organization to adapt. The last item I want to come to is that of purpose. So in terms of a backdrop to this, since the GFC, public trust in businesses, and particularly the financial service industry, has waned, and businesses need to regain that trust in order to ensure that effectively we have a license to operate. I think we can do this by better explaining our purpose, and that's not the products or services we sell, but it's our reason for existing and what we do to make the world a better place. So this, if we get it right, will have two benefits. First, I think we'll be able to better attract the younger workforce, which make up such a large part of our population right now, because they're rightly questioning companies about their corporate purpose and about their commitment to issues of sustainability and fairness. And we ascribe this desire normally purely to millennials, but we see it in our own organization where it's right across the workforce, and people are really quite motivated by a company with a clear moral purpose. Secondly, if businesses as a whole don't do a better job in terms of defining its purpose to society, then that court of public opinion will do it for us, and they'll even further deteriorate their trust in capitalism as a system. I think there are some great examples of companies that have a strong purpose and have done well as a result of that. Unilever is one such organization. It's sacrificed short-term shareholder benefit for long-term value, which is equitable, shared, and sustainable. Patagonia, which is a clothing manufacturer for outdoor adventurous, I guess, have a clear three-strand mission statement which they live by. It's to build the best product, cause no unnecessary harm, and use business to inspire and implement solutions for environmental issues. It's really clear, and it's in everything they do. Closer to home for us as AIG are the New Zealand All Blacks. I know rugby is not a popular sport in Italy, but the thing to know about the All Blacks, which is the team which AIG are the sponsor for, is that of any team in any sport over the last 100 years, they have the best win record ever. Okay? So they're clearly doing something right. Literally, they've won 81% of their matches in 100 years. And you think about a game of rugby, and you think it's just about throwing the ball around and scoring a try. Their purpose, they state, is to inspire and unify New Zealanders. It's at a much higher level, right? And their brand, the New Zealand All Blacks brand, is actually better known than New Zealand is as a tourist destination, a place of 5 million people. It's quite extraordinary what they've managed to achieve. And they do that through having a purpose. So the risk industry, I think, is one with a great purpose. Look no further than what AIG just tackled in Japan as an example. Japan just had its worst cat season for 25 years. There was one typhoon in particular called Typhoon Jebi, which was very, very damaging. We received, over 2 months, 90,000 claims, and our claims specialists have been out there every single day delivering on our commitment. And that delivery, that payment when the worst happens, is right at the foundation of our industry. And if we fail in that, we're in a real difficult situation, and we must prove that to our risk managers going forwards. You also see these catastrophes closer to home, and I know the industry here did tremendous work in terms of the central Italian earthquakes of 2016. In terms of supporting trade, our political risk experts help companies navigating the geopolitical landscape. Our multinational teams constantly monitor shifting regulatory regimes. Our security and terrorism experts help keep companies safe. And our directors and officers products support some of the leaders you saw up here today in times of increasing scrutiny and governance challenges. So in summary, we really do live in very uncertain times. To remain relevant, businesses must become agile, must become resilient, and definitely must better define its purpose. So just as we did 100 years ago in the dockyards in Italy, in the coffee houses in London, we've got to do so now across the world as an industry. We can definitely help customers understand and mitigate the ways that they invest, and if we do this right, we can help them to grow and help them to trade, which is the lifeblood of our industry. We face many challenges, but also many wonderful opportunities. And if we deal with our very expensive value chain, if we fully embrace the industrial revolution, this fourth industrial revolution we're seeing, and we incessantly focus on our customers, I think we're eminently well placed to support society in what's proving to be a very dynamic century. We've got a vital role to play, and my only ask is that we do it at a much higher level. Thank you very much.